So good afternoon. We are starting the discussion today. In fact, apart from these slides, the presentation that we were using yesterday, we might start another section. I believe you all already have access to the second presentation. We will start halfway through, and also there is a reading supplement, so that also would enable most of you all to get a kind of feel on the second topic that we'll be starting today. So I'll first take the presentations that we have in terms of the handouts that we have already shared. Let me have the first presentations that we have shared last week. Where we have come to a certain point where we try to kind of understand the relationship between the financial markets and institution, and then of course how different asset classes behave over the period of time. And even we touched upon what is a financial crisis, but broadly we will come back to the financial crisis topic with greater details, as this is one area where we will be studying in this program. And then also we looked at role of money and this money in terms of money supply, the quantum of money available in an economy at any particular moment of time is known as money supply. And this money supply, how this money supply influence the business cycles. Business cycle is a longer term behavior of an economy represented in terms of its GDP movements, right? So long-term perspective of GDP numbers, you probably see over a period of time countries' GDP in absolute value increase. But at the same time, the speed in which it changes from last year to this year may differ. There may be years where it must be increasing at 8%, then the next year it must be 5%, the following year 3%, and then comes to a point it's almost not growing, stagnant at that point, and maybe go negative. But effectively, if you look at the trajectory of this growth, it is increasing. So this is reflective of a business cycle. We will see these business cycles also in our discussions. And then of course, the periods where you see the economies are not growing, right? So this is known as recessionary period. And you can come to that point in the discussion as we move along, right? So I'm just trying to get if you have any feedback from last week's discussion. You wanted to clarify anything today before we move on to the details? You can share with me in terms of the notes that you have, or you can on your mics and you can speak if you have any clarification required. Right, hope that you all are following. But if you have any question, please drop a mail. That would you can write it in chat as we move on, so we can follow up further on these topics as we are discussing. So what I was detailing out here is I was trying to explain to you all in terms of some details that we discussed already last week, but I am further elaborating in terms of some aspects that we will cover in coming weeks. Then also we try to learn few aspects of monetary theory. Before move on to monetary theory on recession, there are various ways of looking at this negative growth in terms of how you define a recession. That means if you see in countries, for instance, in US, if you see 2 consecutive quarters of a negative growth, you call that period as recessionary period. So that's how they look at recessions. One quarter, you probably see there may be some impact and then the growth might be negative, but they don't call it recession for that matter. But if it is 2 consecutive quarters or longer, they call it as recession. And then of course you see during these periods the unemployment increases, people lose jobs, and the employment opportunities decline, and the economy does not grow. But then expansion, it's the kind of increasing trajectory of economies, activities, more employment's been generated, new investments have been introduced. A lot of activities happen during this period, right? So you see these elements in the discussions that we follow up in coming weeks. And then we try to see some aspects of monetary theory. As I was telling, I will be touching upon monetary theory, not necessarily going to details. And that will look upon the changes to the quantum of money available in the economy, that is money supply, okay, and through which how the economy's activities influence and the price level, that is the inflation influence. So these are the elements that we would look in terms of monetary aspects in this program. And then I touched upon this area also, money, business cycle, and inflation last week, and try to kind of explain to you some relationship established in terms of money supply and inflation across the period. And I was mentioning to you all about Milton Friedman. Milton Friedman was one of the pioneers of monetary economics. He was explaining to the extent where inflation is always and everywhere a monetary phenomenon. Mean to say, continuous increase in monetary stock push the prices up, and as a result, price in the economy increases continuously, and this is the inflation. And if this continues without any control for a longer duration, you probably come to know circumstances of so-called hyperinflation. So what he tries to explain is a mere increase in monetary stock in the economy would not necessarily make people prosperous or their living standard improves, but effectively what it does is it pushes the people's ability to demand goods and services, and as a result, people demand when the production or the productivity does not increase. From the other side, the available stocks or available goods and services prices increases continuously. So you are ending up to a point where even your living standard you had before that monetary stock increase, you probably fall below that level simply because the prices would have increased much sharper and much faster. So this is a possibility the Milton Friedman was trying to explain, and there were periods where money growth reflective in this chart itself, the blue lines, the increase points, and then you see shaded areas. These are the recessionary points in US, when they see higher money supply, and then subsequently you probably feel that the recession incurs and the money supply tries to kind of a decline. But yes, because already it increased faster, and that has contributed some element of inflation, and as a result, cost of financing increases, cost of people living cost has gone up, and as a result, people reduce consumption, and then the economic activity shrink. And then again, money supply tend to kind of behave back to its level, and it's then again increases, and you see the recessionary points in US economy. This is very clear. But what is interesting here is prior to 1980s, the repetition of increases and recession are frequent than post 1980 period. It become less frequent because nowadays the relationship of increasing money supply and correspondingly that has influence on recession and inflation has moderated, because central banks have kind of acclimatized to the extent where they manage the inflation much more effectively in recent times. So you see these possibilities in today's context, right? So this is one element and one explanation we will be trying to discuss. And again, this chart also highlight the details in terms of how money supply and aggregate price level presented in terms of GDP deflator is trying to kind of explain to you the general details. And then some relationship across different countries during the period of 2000 to 2010. You can see some countries who had higher money growth, money supply growth, had higher inflation numbers. You can see the positive upward relationship. The countries who manage their price levels well, they also manage their money supply growth in a lower number. So you can understand the positive correlation in terms of money supply and price level, right? So you see the details in terms of these money supply numbers, and then of course the price level numbers, and we will get into that element in the discussion. You have any questions before I move on to the next slide and detail out the information? Hope you are seeing the slides, right? So if you don't have questions, I can move on, but if you have any clarifications required, please drop the message, or you can unmute the mic and you can speak, so that would make a little more clarity in terms of the discussions, because I always wanted these discussions to be much more like participative, rather than I'm just continuously kind of detailing out of the subject matters. So you see here, we also look at so-called money and interest rates, and you probably already aware to the extent that we have explained that interest rate is nothing but the price of money, or for that matter, we also, that is the rental income of money that we discussed in last discussion. But what is important here is we will try to kind of get into this interest rate business in greater details as we move on. Most likely starting from next week itself, we will get into these interest rates behavior and things like that. So this is interest rates, that's called as price of money. And you probably see these interest rates prior to 1980s, the rate of money growth and this interest rates on long-term bonds were closely tied in international markets and international financial markets. When the money supply increases, correspondingly, you would have seen the relationship with inflation. Inflation also tend to increase, and as a result, you probably see the long-term the financial assets interest rates also started kind of increasing, because higher the inflation, they expect higher the return. So automatically you probably figure it out, kind of a relationship, positive correlated relationship. But then it's gradually started weakening since 80s, because there are other measures through which financial markets started making interest rates behave orderly, and also inflation started behaving well anchored in recent years. So the argument and the explanation here is the relationship is little muddier, if not less clear in recent years, but the rate of money growth is still an important determinant of interest rate. There are other ways of managing inflation, the interest rates, but you see still money supply. You blindly increase money supply, you probably end up having creating inflation and then high interest rates in the economy. So you try to kind of understand this relationship from a broader perspective, and then you see money supply growth and inflation numbers across US. This is quite a long time series information. A red line shows the interest rates, blue line shows the money growth rate, and when the money growth continuously increasing at a reasonable pace, you probably notice that the interest rates are also heading north. It is also increasing. And then when the money supply started slowing down, still it's growing, but not at the same speed as what you see prior to 1980s. And then you see interest rates also declining. But you probably see in financial crisis in 2008-9, where the money supply again started growing fast in US and rest of the world, but interest rates did not increase. Interest rates in OECD countries, especially in US, almost hit zero flow. In some countries, interest rates effectively become negative, right? So today you invest and you pay for investing. In some cases, interest rates of Japan, interest rates of European Union, that became negative, right? You invest 1 million euros, 1 billion yen, and you take home after 5 years or after 2 years less than that investment. So it's very interesting phenomenon in the environment in which that we are now seeing these developments. So these are the details that we would be getting in. Okay, so what you also see is fiscal policy and monetary policy to some extent. You see monetary policy is the management of money supply and interest rates. You probably get to this area when we start talking about central banks. What you are simply seeing here is the US experience as well as the conduct of monetary policy. But we will try to elaborate from Sri Lanka's perspective also, as and when we discuss the US Fed Reserve's experience. And you see this relationship in terms of monetary policy, how they manage the quantum of money available in the economy, so-called money supply, and how they look at the behavior of interest rates and how they try to influence the interest rates to a level where they believe would influence the real economic activities. And then you see the fiscal policy. We are not spending time on fiscal policy, but we would look at very broadly some elements of fiscal policy in the discussion, because that you can't ignore, because you have to have the understanding of these two to get a kind of a relationship built. So fiscal policy deal with government expenditure and revenue. That is one side spending, and from the other side taxation related matters. So you probably hear about so-called budget deficits in fiscal policy all the time, and that is nothing but the excess of expenditure over the revenue for a particular period of time. Deficit is higher the expenditure than the revenue. Then you see a surplus, which is nothing but the revenue is greater than the expenditure for a given period of time. But most of the countries in the world are experiencing deficits, especially in the emerging frontier developing economies, right? Any deficit anyway has to be financed. That financing is done through borrowing. So financial assets become very, very important aspect of borrowing all around the world. So you see these elements in our discussion all throughout, right? So these are the areas that we would be looking at, and then some empirical evidence in terms of how the deficits in US and how the deficits become surplus at different times, and deficits increasing substantially during crisis periods like financial crisis. You see it's almost hitting double-digit numbers even in US, right? But they can recover very fast when the economy start doing well. So even the current period of COVID related, yes, these economies having difficulties, but they are trying to kind of work through these developments in today's very challenging financial market circumstances, right? Then you also look at some elements towards the latter part of this program on foreign exchange market, but I don't see that we are getting into this in detail, because this is not necessarily the kind of a concentrated area, but some element of forex, foreign exchange market, matters to us because we try to build relationship with other macro variables. So you see the foreign exchange market is nothing but a marketplace. It's not like a Sunday marketplace that or a kind of a place where goods and services exchange. But here it's often foreign exchange markets are electronic platforms in today's context. And here what you do is funds are converted from one currency into the other. So you have the US dollar, you convert that into Japanese yen, European, the soaring, the UK pound, sterling pound, or for that matter, Indian rupee or Sri Lankan rupee. It's conversion. You make one currency to the other. So this is a foreign exchange market. Okay. So foreign exchange rate is the price for one currency. So you say foreign exchange rate. So it is nothing but a price of a good that you are familiar with, the coconut. Coconut is, let's say, 110 rupees now. So you express in terms of coconut there. Coconut is expressed in terms of Sri Lankan rupees. So similarly, when you say US dollar, you say 185 Sri Lankan rupees. So similarly, when you say a Japanese yen, 101.8 rupees, right? So it is expression that you are making. So it's the rate. So the foreign exchange rate is the price of one currency you express in terms of another currency, right? Like whatever goods that you see and you quote them in Sri Lankan rupees. That's because Sri Lanka's a medium of exchange money is Sri Lankan rupee. So you express that in Sri Lankan rupees. If you go to US, you probably say in US dollars. So it is the way in which the foreign exchange market defines some of these concepts. We will not detail out, but we will touch upon some of these concepts in our discussion. And then you see in the market, you determines the foreign exchange rate because you exchange, convert one currency to the other, and through which you define the exchange rate mainly through demand and supply forces for that particular currency, right? So when you say exchange rate, you should be able to say it is the price of one currency expressed in terms of another currency. So these are the kind of, very simple but very clear definitions and understanding of aspects in financial markets that we will try to kind of, gradually get into ourselves and try to learn throughout this program. And see here the behavior of US dollar expressed in terms of an index, right? So index is they pooled all weights into a basket here, and then they express across the period of time how the US dollar's value is behaving. So it is not necessarily volatile in recent times since 1990s, right? But before that, before 1990s, especially in early 80s, it is losing its value. It's going higher than 100 most of the time. This is the period where US also had significant inflation. You will see those numbers when we move in and discuss these details in our coming lectures. Right, then you see international financial system. Yes, we touched upon this also in our discussions. This is because today's financial markets and also the financial and monetary aspects that we are discussing cannot operate in isolation, right? It's operate increasingly integrated basis all throughout the world, right? So the financial markets have increasingly become integrated. One market's behavior influences the other, okay? So we will get a little feel on international financial system, right? And this has a significant influence on our domestic economic activities, okay? So how you match in the international financial system depend upon your choice of exchange rate policy and its impact on monetary policy, because most of the advanced economies, OECD countries, probably see a more clear exchange rate direction in terms of market-based exchange rate management. And in other developing an emerging market, possibility that you have some managed aspects, the managed float. It's not a free float like what you see often in OECD countries. Some managed float is there, and the monetary policy influences some of these decisions and aspects. And also in some markets, you see, you do not let money to freely flow in and flow out, right? Freely money is coming into your economy is inflows. You often try to encourage inflows, but when the money is trying to go out from your economy, you try to bring blockades. So those are some element of controls, but most of the time current account, that where you bring in goods and services, are reasonably open in world in today's context. But capital, sometimes you do not necessarily allow to move freely. So when you see these type of aspects, these are known as capital controls, but this impact domestic financial markets and then of course overall performance of the economy. And if you see the saving investment gap, so if your saving is not enough to meet your investment requirement, you have to let assets or the finances to flow into your economy to match the gap of saving versus investment. So then only your economy would grow. So if you do not let these capital to flow in freely, probably you will not grow to your full potential. So these are the aspects that you will look at to some extent in these exercises. And also what type of a role multilateral financial institutions play in today's financial markets and monetary economics per se, especially the role of IMF to some extent would be discussed, and you probably see these elements would drive our economic aspects in a greater way. So we will look at all these elements in our discussions, and how we will be studying this, how we will be designing or defining our approach to this program, right? You have already learned, and you probably have an understanding of how I might be taking you all through. Okay, we will be doing a very simplified approach to demand for assets, right? So assets are the financial assets that we are discussing here. Okay, we will look at a approach of demand for goods and services that you are familiar with in your economic classes. A similar approach would be brought into the discussion, but we would be looking at financial assets, right? So then we look at so-called equilibrium concept. You are very much familiar with these things, right? So supply side, demand side, we will look at, because these two interact, as I was mentioning, foreign exchange and the marketplace. whatever that you are simply seeing is the concept of equilibrium. Supply and demand meet each other. That's where the equilibrium is, right? So then you see basic supply and demand to explain the behavior in financial markets. Yes, what happens to supply, what happens to demand, and then what happens to the financial markets and financial assets, particularly interest rates in this aspect. So when the demand increases, what happens to the interest rates, and if the supply increases and how it's behave, all kind of things. At the same time, the financial market participants, including banks, they all have profit motive. They're not non-profit voluntary organizations. They all wanted to make money. So the money motive, profit motive, drive the markets to clean and clear up arbitrage opportunities. If a profit point exists, market quickly move into that and try to kind of make sure that nobody excessively benefiting from profit opportunities, right? So you see these demand and supply forces work in the financial market. So that's how we will be trying to understand the basic elements of this subject. So then you see, we look at a financial structure, right? And there we look at so-called transaction cost and asymmetric information, right? Very, very important, right? Asymmetric information. Parties to transactions do not process equal amount of information. They have asymmetry, no symmetry, no equality, right? Even if you have knowledge, right? The parties to the transaction have different level of knowledge to evaluate, review the available information. That itself create asymmetry again, right? In the first place, you don't have information, equal information. There are some information is there, but that's not the full information. And then from another perspective, even if you have same information, right? Your level of understanding differs for various reasons, right? So that creates opportunities for one party against the other. So that's why financial market regulation, supervision, and other related elements come into play and introduce minimum standards of information disseminations. So you have to have at least this amount of information being published periodically for people to understand. So these are the things that we look at. Then the transaction cost, right? So it is very important in today's context, because you can't just make sure that carry your goods from here to another province and sell. You have to carry, that means you incur a transaction in terms of transportation, labor, other related costs. And some products you can't carry like that. It's become perishable goods and services. Goods mainly, yeah. Right? So that has a cost. So this all involves into the transaction element. So how best you can fit these things in today's financial markets and define these costs being minimized to the greatest possible extent, and then reduce the asymmetry in transactions. So these are the elements that we would be looking at. You probably see the financial crisis. So the financial crisis occurs simply because this magnification of this asymmetry in the markets. Market participants do not have information, and this get very, very magnified at times of financial market difficulties. And we will look at a kind of a brief aggregate supply and demand analysis. But from my previous experiences all throughout in this program, we do not get into this area of discussion, because we kind of finish the time available for discussion in this program by the approach of this topic, aggregate supply and demand analysis. Like, okay, so this is how we look at this program. And I already said the textbooks that we are using is Frederick Mishkin's. The details of this book is already available in the slides itself, so you can have a look. And we will follow these handouts in greater details in discussions, and I repeatedly requested that you all follow up these and then have some understanding of some of these concepts by going through whatever available information sources online. You can Google it, you can figure it out, read business information, financial papers, and then you try to kind of read through some aspects of central bank publication and things like that. These are very important aspects. So that would give you much beneficial position in terms of understanding the subject area and also answering your question in the exams. But more importantly, the knowledge that you are trying to gain through this program would not only serve you in terms of examination, but throughout in terms of your careers and understanding of what's exactly happening in the financial markets and a broad economic sense, what the central banks does, and how these things being linked up through international financial markets in today's context. So that's the broad introduction to this program. I couldn't complete this full picture last week, but now you have a broader picture in terms of how we will be looking at. So these are the areas that we are touching upon at different points in time. So that's the point. I just pause for a minute to see whether you have any questions before starting the next topic for discussion. You can drop a message even through chat mode here, right? So you have that option, or you can unmute and speak. That would also help you understanding some of these stuff much more clearer. But at the same time, if you wanted to follow up things in your own pace, yes, you can even take up some of those stuff and keep a message being loaded into the chat, so I can then again follow up and discuss that in the presentation. So you see these elements, and we will see the next topic. That is the overview of the financial system. I think you all have the handouts, and also together with this, there is a reading supplement I shared with IBSLES that also loaded into the program details, so you can have that also for this area of discussion. So I will detail out very of course, the reading supplement I would not necessarily detail out, but the presentation, yes, we will move through this element, because this is setting you some understanding about how the financial system is generally structured in an economy. And in this subject area, we look at financial markets. And actually, I look at from a broader sense, bond and stock markets in discussions, because that more or less take a very big share of financial markets everywhere in the world, right? And then we look at financial intermediaries. These are the institutions, right? Mainly the banks. And there's various ways of classification of these banks. Some call licensed commercial banks, LCBs, licensed specialized bank, LSBs, licensed savings bank, specialized savings, and then you see finance, pension, insurance, all kind of different ways of financial intermediation carried out by these institutions. We will kind of see these agencies, and also we look at the basic function of getting general public together by these markets and institutions, right? By moving funds from those entities who has or who have a surplus of funds. For instance, I name it here one Walter, to those who have a shortage of funds like Peter, right? So Walter has surplus, Peter has a deficit. So the markets and institutions try to get these parties together by moving their assets into the financial markets and facilitating them to meet their financing requirements. So this is broadly the way in which the market tries to work in today's context. And more detailedly, we look at individuals, Walter and Peter, but more than them, what matters is a more realistic sense, the institutions, right? So you call it IBM, Google, I mean, any institution, they have better financing proposals for new product lines, let's say a better form of new iPhones, whatever, okay? They need to kind of have resources in the form of funds to bring it out to the market. You've probably seen some of these agencies issuing new stocks like IPOs. Even Alibaba had a go recently. Even you probably see the Saudi petroleum went for a biggest IPO recently. So these are the things that they want this money in the financial markets. And Sri Lanka too, the institutions or the companies wanted to have the new activities being funded. So for that, they need resources. So they try to get these resources through financial markets. Like they become Walter and they become Peter in such circumstances, and they wanted people like Walter to come and invest. And similarly, other institutions, right? Okay. And also from a broader perspective, you see the governments, even local government, municipalities, they want to build roads, schools, they need funds. And I already said budget deficits. When you have deficits, your expenditure is more than your revenue. So you have to kind of bridge the gap through borrowing, right? So the markets are there. So the well-functioning markets and financial intermediaries are very important for the economic health of any economy. Well-functioning, right? So there may be markets, but may not be well-functioning. They might have a lot of loopholes, working inefficiently. Then it's not a well-functioning. And there are certain type of features we will look at, so that would define what is well-functioning and what is not, right? So you see these markets, and then how they behave and how that influence the overall economic health. Okay, so to study the effects of these financial markets and financial intermediaries on the economy, we need to understand and acquire the general structure and operation of these markets. So that's one purpose of this area. Okay, so in this lecture, we try to kind of learn about major financial intermediaries and the instruments that are traded in financial markets, as well as how these markets are to some extent kind of pinched through regulations, right? So that's the focus of this area of discussion. Any questions? Right. So it's from you are very quiet, most of you are. So that shows that you understand these things. So invariably, you are telling me that I can move fast, right? So please understand. I mean, when you don't raise anything, I understand that you get the full picture very clearly. So I might tend to be a little more fast in my explanation and things. So you can slow me down if you have clarity, you wanted to detail out anything, right?
Excuse me, sir, can you just explain the difference between the financial market and the financial intermediaries?
Financial market and a Second part, I didn't get it clearly. Financial market and a
financial intermediary.
okay. Intermediary is the institutions. Okay. Institution is one element of many things. You see financial assets there. That is also one element. Intermediary is a financial agency who act in between buyer and a seller of a financial product. But when it comes to this intermediary plus asset, financial assets, the regulatory aspects, and then the infrastructure like trading flow, stock markets, right? This is all pooled together. Then you see the market. Market is not only the intermediary, but everything else, right? So financial market comprises of every aspects of financial activities that we probably be looking at. Assets, institutions in the form of intermediaries, the regulations that we are looking at. It is a place, marketplace. Financial market is a place, but effectively it not necessarily a one particular physical location, but there are physical locations which are very famous in the world as financial epicenters. Wall Street. In Sri Lanka too, you probably see certain areas in Colombo City, which is already becoming a financial centers. Now, possibly we see a port, new financial cities coming up. So, which is not only financial aspects being looked at, the reclaimed land, you probably see focus is to have a financial center also been established there, but would have other elements also. It is a place through which financial assets exchange hands, sellers and buyers. But this element of financial market requires sub-elements. Intermediary is one of them. Okay, financial intermediary is an agency who act in the financial market and of course make profit through these activities, right? So the profits could come through margins, profits could come through fees, profit comes through consultancy, or their own buying and selling of financial assets. So there are various ways of looking at it, but what you are basically trying to understand here is one element in the form of intermediary within the full set element in the financial markets as a whole. Okay, so financial market, again I'm highlighting here, is a broader term describing any marketplace where buyers and sellers participate in the trade of assets such as equities, bonds, currencies, derivatives. These are all assets that we are talking now. So the buyers and sellers participate in this market. So it's a full-fledged environment. This could be physically identified in today's context, but at the same time, virtually, you can do all these transactions in today's context through a global financial system. So we don't go to physically go and sell our products in international capital markets. We stay here. But through various forms and arrangements, we activate those, and the people who are transacting also aware of those arrangements. So this is a financial market features. Okay, and then financial markets are defined by having transparent pricing. These are the well-functioning markets that I'm telling you some features. So when you see well-functioning markets, those has transparent pricing. Prices are determined through forces of demand and supply. It is transparently reflective in terms of how the ultimate price is determined. Basic regulation on trading, right? First come, first serve, or highest bidder would get priority, right? So the various ways of regulating, unethical practices being taken out of the equation. Insider trading is penalized, if not can be costly in the form of a reputation and other related consideration. Then you have cost and fees. You have a fees in terms of a certain percentage of aggregate numbers that also involves. So how competitive the markets are when these cost structures and fee structures become reasonably negligible, right? So that's also a very important aspect of these markets. And then market forces, as I was mentioning, transparent pricing is the way in which the prices are determined also need to be transparent. But the determination of price process is through the market forces, right? So these elements typically describe a financial market, but also you see the read supplement I have shared here. So you have that, and you can again read through that, details out types of financial markets and their roles, because even within financial markets, you could have commodity markets, financial assets markets. There are various types you can see it. And also you define these markets in the form of capital markets, money markets, right? So I'm not trying to detail out in this discussion because you can read these things, right? So for instance, the financial institute, financial assets, financial securities of long-term nature are traded in the capital market. Then you see a primary market and a secondary market. Primary market, you see a presence of the issuer or the borrower is visible. For instance, government of Sri Lanka sells treasury bonds, treasury bills. So they sell in the primary market. So the primary market, the government of Sri Lanka, on behalf of government of Sri Lanka, central bank sells that. Their presence is visible. They are the ones they are selling. It's a primary. So once you buy from the primary, right, you then sell that in the secondary market, transact that in the secondary market between you and your friend, one institution against the other, right? So that's a secondary market. So there it is exchanging the ownership from you to the other, either permanently or temporarily by doing repos and things like that, right? But when it comes to primary market, you create the assets. You create the assets, right? So assets being created and transferred to the investors. In the secondary market, the such created assets being exchanged hands between investors. So there are various types of markets within financial market itself. So, I mean, I'm just glancing through some details for you all, but you can go into these and read. And then, of course, what is a bond and things like that we also will be discussing. So I'll not try to kind of detail out here. Right? But very interesting, because this information would not only give you a very clear understanding of these concepts, but also this would help you in answering some very simple clarification, detailing out instruments and things like that for your kind of a general exam purposes. So then you see money market, where you see short-term financial assets, less than 1 year, often trades. Okay, this is like a liquid, highly liquid, like you buy today, sell tomorrow. You basically do not try to kind of buy and hold till maturity like any financial assets here in money market. Money markets are often for parties who are having reasonable acumen in financial assets, or for institutions who are reasonably active in financial assets. So this is like treasury bills, treasury, not necessarily treasury bonds and long assets, but treasury bonds also for remaining maturity of shorter duration, like less than 1 year, could become a money market asset, right? So there are various type of repos and other details. I'm just giving you in money market, that's how they look at. I mean, short-term, highly liquid assets are traded. So you see this type of elements. Then cash, spot, Okay, so cash is immediate, spot is usually T is trading day, T plus 1. I mean, you can define like T plus 2. These are kind of a jargons you will come across if you speak to people who are working in treasuries, right? So cash market, spot market, when you do a transaction and transaction settles now itself, it's a cash. So you do it now, it's settled. But generally, when you do a transaction in a financial asset market, it could be spot. Foreign exchange market is often spot, unless you precisely say it's cash or spot next or spot forward. Various ways of explaining them, but you are basically saying spot next, or spot means T is transaction date plus 1, next business day. So that's how the markets work. So these are all established. That's why I said rules and practices and fees and cost systems. These are well-functioning markets. These been established and followed by everybody. And anybody breach, he get penalized. So there's various ways in regulating these aspects, right? So you'll see these elements being discussed. Then you'll see derivatives. Derivatives are named in terms of it derives its value from underlying assets, right? So derivative is not necessarily standing on its own. It stands on underlying something, underlying assets. So it's generate its value from the behavior of underlying assets prices. Okay, so these are the things that you will come across in these markets, and you will try to learn a bit here, what it is, how it is, what type of assets trades and things like that. So we are not trying to getting into how the prices in derivative markets. Those are very much for financial analysis kind of program, portfolio management kind of program. We are not getting into those. We try to kind of glance it, introduce it, and let you understand these are there in the markets. That's how these elements being looked at. Up. If you're really interested in, you can actually swim into these and learn. So that's another level for you all. But just to kind of give you a glance, this is where the world is, right? So you'll see these elements. Then you'll see Forex, foreign exchange. I short me to say Forex. That's how foreign exchange market call it, right? Then you'll see interbank. Interbank is between banks, right? So interbank market is the financial system and trading currencies among banks and financial institutions between intermediaries. Okay, so there you probably don't see retail investors like you and me or small trading parties. So it is for institutions. They themselves trade without collateral. In Sri Lanka, you probably know the call money. There's a market called call money market. So that is the market between banks. Bank A, Bank B, without any collateral, they exchange funds, right? So the limit's been established because of your credit worthiness, right? How much maximum cap? Beyond that, I'm not lending to you. Although in the call money market, we know each other very well, but we have set our limits. So that's the most liquid in the form of exchanging money market assets. Forex is foreign exchange, okay, where the currencies are traded. And you will get kind of a glance already into some of these concepts, but you can kind of read through. And as I said, primary and secondary, right? Primary market where new security is being issued, okay, either through an exchange or a arrangement like primary auction systems or things like that, okay. So primary market is also a new issue market. As I said, that's where the asset is created, right? So then you see secondary market is where investors purchase securities or assets from other investors rather than from issuing companies themselves. So the issuer is not necessarily present there, but issuer could also act as a trading element in the secondary market, okay. Then you see the OTC. OTC is over the counter, right? So you don't necessarily see everything in the financial markets trade on the screen. Sometimes it is really worth transparent, but unfortunately that also has its demerits. So for instance, if you wanted to sell a big quantity of financial assets, very big quantity of financial assets. So if you put that in the open for everybody to know, right, what happens to the prices? It's like you have a bumper harvest of mangoes, right? You take the mangoes to the weekend market. When everybody sees that there's a huge stock of mangoes and everybody knows that this person has to sell this, naturally the price of mangoes will go down. That's higher supply. It's simple economics, right? You more and more products, the coconuts, if you hit bumper harvest, rice, when you see bumper harvest, the prices reduces because more supply. So the markets for such in the financial assets, what they do is they do not openly discuss the big quantity transaction. They do it outside the open, transparent pricing structure, but over the counter. You discuss over the table with me, right? The seller discusses with the financial intermediary, and financial intermediary knows, okay, 1 million stock of this company is available for sale, right? So he tried to kind of figure it out. Anybody who is like to buy 1 million stock of this particular company. As I said, somebody is trying to sell. What happens to the prices? Prices reduces. But when somebody tries to buy, what happens? The market is having only the general average stock. But that stock is not enough for a one particular person. He wants to buy more than that, double of that. Even you and me wanted one piece each. We would rush to buy that. So the seller would understand, oh, there's a big quantity demanded now. I can increase the price. So this volume-based elements also play a big role. Not only the volume, there are other elements also. Right? Some financial assets also play in terms of credit worthiness. What type of people buy? Even the people who try to go and buy certain type of assets, others also follow because they are well respected and they do very much a right decision all throughout. So there's a kind of a feeling, okay, this fellow, this participant is buying, this institution is buying. They are very powerful. They have real assets. So everybody is trying to go behind those assets, right? So OTC is over the counter. Okay, it's a secondary market, right? It could be primary market also, but then it's a placement arrangement. Okay, right? So the over the counter refers to the assets that are not trading on exchanges, right? That the assets trade either on the over the counter or they're sometimes called pink sheets. Pink sheets is you don't reveal the party also, right? So you do not tell, I mean, I'm the one who's buying, I'm the one who's selling. No, that also not known to the market participants. So very interesting. I mean, that's how the markets work. So you see this OTC markets kind of arrangement, and third and fourth markets. These are all details for you all, right? So I just leave at this point with the reading supplement. You read through very interesting aspects that you are learning now itself, right? And this would help you to gain a substantive understanding of how market aspects play. Markets aspects play in a role, play a role in the financial market itself. Any questions?
So can you just explain the OTC market with an example?
Okay, okay. OTC market, it's everywhere. OTC market, stock market is what you are simply seeing is the screen. You buy, somebody is selling. The seller doesn't know who's the buyers, right? So he is willing to sell 100 stock of a particular company at 185. You are willing to buy 500 stock of that company at market price prevailing at that moment. So you buy 100 from him. Next person who is ready to sell, he said 185.50. You buy that $100. So likewise, you match the transactions, right? But interestingly, what you are simply seeing is OTC. Now, if somebody is in the stock market, a big stake, 10% of the company is owned by this party. There are transactions. They do it through intermediaries. They don't come open and sell that, right? For instance, there's a big sale of John Keel's holding sometime back to Malaysian investor Khasana. Big holding, right? So how that transaction happened is it's over the counter. The parties negotiated outside and he came and purchased. He did the transaction. So it's OTC. And also when it comes to big investments in, let's say, government securities market by foreign institutional investors, right? Big institutional investors, global investment giants, they wanted to come and invest. So the 100 million they bring in is equivalent to, right, $1 million is equivalent to 185 million rupees. So 100 million, you can just calculate it and say it's billions, many billions. So if somebody wants to, right, straight away buy this from the OTC market, prices would fluctuate. So he buys that. So OTC markets are like that when it comes to financial assets. So you deal the transactions. In the stock market, you see OTC transaction very regularly. In the bond markets, you see OTC transaction very regularly. And in the foreign exchange market, you see often OTC transactions happening because big volumes exchange. People's Bank, Bank of Ceylon, they do transactions for CPC. They wanted to pay petroleum related bills. All this happens OTC. They don't openly come and reveal your full volume that you require, right? So they bring those elements after the transaction, so that it's happened already. Market get to know the details within a short period of time. You had to report it. Those are regulatory requirements, right? But you don't bring them into the market openly, simply because if you bring that element into the equation, there may be immediate price volatilities because of that transaction itself. So they do that, and because of that reason, even sometimes somebody wanted to have a big transaction, he split. He breaks his transaction into small pieces and do. There are various ways of handling this, so you can understand these things as you study this subject and as you get to know some elements of these, right? So there are some other questions also. Derivative, what type of assets are backed? You see, almost all the derivatives are either backed by stocks, either backed by bonds, treasury bonds, and then of course you derive a value based on your stock or the bond price behavior in the market, right? So you produce a forward transactions, you introduce a forward contract underlining goods or a commodity, right? So it's a derivative. You don't have without that underlying crop in your mind, right? So the transaction is derived from underlying assets. So that's the derivative. Those are very common examples. Then you see Derivative markets, limited derivative markets operate in Sri Lanka. It's not that deep like in OECD markets. Okay, there may be speculative tradings, speculators in markets, very famous speculators. Those are like works through so-called inside information, insider dealing, inside informations. Like the directors of the companies, they know the information of what they are going to do in first place over the next year or so. So how public quoted companies need to be behaved is regulated. So to avoid somebody's making use of that information for his price or individual benefit. So this could be speculators. But if you wanted to learn about derivative markets, I simply kind of encourage you to kind of learn financial analysis, right? It's investment and portfolio management. Here you will not get into that aspects. Here we broadly see these are elements of markets, right? So it's available in Sri Lanka. You see some derivative products are available. You see forwards. You see the repurchase transactions backed through assets behavior, and stock market transactions backed through margins and things like that. Yes. So those are the elements you probably come across in deep and well-developed financial markets on a regular basis. Please feel free to, I mean, if you wanted to clarify anything, drop a message so we can follow on that basis. Right. So we are moving on. We are moving on to see functions of financial markets. Now you know what is a market, what is intermediary, different type of markets that we were discussing all this time. So these are the details. So see the functions of financial market. So the basic essential function of a financial market is it's channel funds from economic players that have saved surplus funds to those that have a shortage of funds. So it's a function of channeling surpluses into deficit entities. That's a very conventional and essential function of a financial market. It's a marketplace that facilitates excess units to, right, transact, if not exchange the excess assets to shortage entities through creation of financial assets. And you probably see, even if you go and deposit with a bank, means you see you are basically investing your excess funds. You are investing, that's a deposit. So that funds being used to loan out to somebody by the same institution, or that institution would go and buy bonds and bills and stocks and other assets in the financial markets, right? So then you see another function of a financial market is direct finance, right? So there's two aspects of financial market structure. One is direct finance, other one is indirect finance. We'll come to those in greater details. But direct finance, you borrow funds directly from lenders in financial markets by selling them assets. So when the financial market is there, like what you do with intermediaries, you don't need to go through all that. If you are capable, you have knowledge, you have particular skills and arrangements, you yourself issue securities in the market. This is what all top leading institutions do, companies do, corporations do. They issue assets, they issue bonds, they issue. They probably get the services of related agencies. That's a different call, but it's a direct. Your presence being highlighted in the market. Yes, Bank of Ceylon is offering a certain amount of capital-based debentures. Recently, they have offered, right? So it's direct. Their presence is there, and people come and buy from them. So they give them the securities. What is the security? We'll explain them. We'll come to that point as we discuss and move on. So they directly, their presence is there. Direct finance, where you yourself, right? You yourself make arrangements to issue financial assets, and the investors directly buy from you, right? You don't go through intermediaries that the bank is funding your company. It's not the final investor. The final investor may be thousands of people who invested in that bank, deposited money in that bank. We call such as indirect finance. We'll come to that point. But direct finance is you yourself issue securities, bonds, and raise your required funds. So the direct financing is also another major function of financial markets. Okay, so channeling funds from surplus units to shortage units, and then direct finance. These are major functions of any financial markets, right? Okay. Then promotion of economic efficiency. Okay. So by producing efficient allocation of capital. How? You don't necessarily know. I mean, small timers, small savers, we would not necessarily know I'm going to invest in ABC company, XYZ company. They are doing this type of business. We don't have that acumen, and we don't know how to go through greater details of that project. We don't know this Pfizer and this company is producing this vaccine, right? Because our understanding about that subject area is not that great. We don't know the companies they are trying to kind of go to space and bring certain things to the mankind, right? So there may be a number of agencies, they're doing oil refinery and things like that. Our capacity of understanding is not that great. So what happens here is you try to do on your own to invest in those assets, you would hesitate, you would not know. But you yourself would go and park your excess funds with the financial intermediary. So the financial intermediary would look at, among other things, the risk of the project, benefit of the project, cost benefit in a very simple sense, whether that project is worth investing. Right? So he would see all that details, and he would allocate resources on the basis of most advantageous, less risky, and return is reasonably assured. Yes, he has to find risk elements also into the equation, risk return characteristics. You know, higher the risk, higher the return. These are very simple things that you have to remember, right? But what is interesting here is the financial efficiency, economic efficiency is achieved through financial market by going into all these details and finding the most suitable project to allocate the capital that you have gone and parked in those agencies. Those intermediaries have their assets, but they're also mindful they have to manage those investments. They have to pick right investments. So efficiency is there. It's not that sometimes politically motivated allocation of resources. So then it's not on the basis of sometimes efficiency. They would allocate resources to their friends. their families, their known parties who help them to get elected. These are common things everybody knows. So the parties who borrow also are aware that the money received for them is basically favors for their association with the politicians and things like that. So they probably not even bother to pay them back. So this become non-performing loans after some time. But when it comes to efficient allocation of capital, financial intermediaries are mindful that the financial markets would take into those and allocate resources efficiently. If you have 100 projects, they would pick the most beneficial one first, then they will go into second, and accordingly they will allocate resources. If they have all 100 and all 100 is good, they will do so. So that ultimately increases the capacity of the economy, the production capacity of the economy grows. So this is another function of a financial market, allocation of resources efficiently and efficient usage of capital. This is another function. Okay. Then you see the financial markets helps to improve the well-being of consumers. You, me, everyone else are consumers of financial markets. They help us to purchase time better. When I say purchase time better, probably you try to kind of, understand what is this. Right. So you and your friends, everybody is having completed your studies. Let's say you have finished your degrees. Now you wanted to start a very good career. Yes, the job opportunities are also there. You have got into a well-paid, reasonably facilitated in terms of other perks in employment. And at the same time, you also have your plans in terms of your marriage, in terms of building a house, in terms of purchasing a vehicle and traveling as far as possible, traveling out. But because of COVID and things like that, now it's difficult, right? So there are various things now. It's slightly differently worked, but still, you see, if you do not have financial markets to facilitate, and your parents or your inherent assets of your family do not facilitate, you would have to work 60 years to build a saving, right? Up until you reach 55 lakh, you would not be able to build a house because your saving from your income would not be sufficient. You have to save continuously, and in between, if anything happens to you or somebody steal your assets, that's a big problem. And your parents also do not have that much because they have already spent for your well-being in terms of educating you all, bringing up you all to this position, right? So they also now wants to have some time for them and enjoy. So the whatever left in terms of their earnings that they probably be using for their own well-being and for their medication and things like that, if you are not in a position. So see, I mean, your requirement to have all this in your young age itself is possible now because you can access to financial intermediaries. Otherwise, what happened is, after you working for 30-40 years and building a very nice house with upstairs and you nicely tiled parquet and with all other amenities, you would not be able to even climb the stairs. You are using a walking stick. You slip and fall when you walk on some of those because you are old and you probably have other difficulties, right? So you build everything and you lived all your working life in a kind of rented and not preferred kind of arrangement. You could not buy a good vehicle, whatever. So what happens here is the financial markets lets you plan your future consumption today based on your expected earnings. So that's one way of looking at the time purchasing better. But at the same time, you have a brilliant project plan in your mind, right? So you wanted to expand on that project plan and you have brilliant study plans in your mind. You can't have assets to invest for your studies. You get study loans, you get study facilitation, all by the financial markets. So you understand it's help you the well-being in terms of allowing you to purchase your time better, right? So you don't need to become retired and want to drive a SUV when you don't see the roads properly. You can't even have spectacles, but spectacles would not help you to have that much clear vision in terms of making use of all available facility of SUV. So think about these things. So this is another important function of a financial market. Any questions? Right. So let's move on. Right. Then you see the flow of funds in the financial system. So I said direct finance and also indirect finance. Okay. So you have stakeholders in any economy. You can put them in one side as savers. They are the surplus entities. Actually, they are the ones who lend out funds. So there you probably see households, businesses, the government, and external parties, including foreigners. They have saving, they are ready to lend, right? They have excesses over and above their consumptions, they earn. So that's the one side of the equation. And another side in the equation is so-called borrowers. So they want to spend for various purposes. We don't want to get into that, but they don't have enough resources. So they wanted to channel some saving from the other side of the equation. So they also include business firms, even households, the government, foreigners, all there. It's no different. So you see how the savers channel their funds to these borrowers, either directly through financial markets. That's the blue colored direction that you are seeing here. The savers directly channel their funds to the borrowers or the parties who are having a shortage of funds, assets, right? So the financial markets is in the middle. So through financial markets, they channel their assets directly to these parties, directly. The borrowers design financial assets and offer to investment in the financial markets. The government, businesses often do. They issue bonds, they issue bills, they sell assets, all kind of things. Or the savers, they don't know the borrowers in this instance. They go to financial intermediaries. The financial intermediaries pool all the savings by these agencies. they pool. One might bring 1 million, another one bring a 1,000, another one bring 1,00,000, another one bring a multi-million, and another one bring billions. Many people bring different levels of assets, savings, and park their savings in the financial intermediary, let's say bank. So this bank pool all that and then go to the spenders or the borrowers, business firms, government, households, even foreigners. They directly, not the saver, but the financial intermediary directly deal with them, or through their another intermediary, right? Foreigners for that matter, they are not directly dealing, there's counterparts in those markets. So through which they channel these savings to those borrowers through formal arrangements of agreements, formal contracts, various forms of formalities. So the funds being channeled now, not directly, but indirectly, where the presence of a financial intermediary, and the financial intermediary is the one who establishes the contract with the ultimate user, that is the borrower here. So the finance that you had been channeled to the borrower through the financial intermediary, bank in this example, and they have directly lend out to those agencies. So you don't know to whom your funds have channeled. Your contract is with the financial intermediary, that is the bank. Similarly, the borrower doesn't know who invested in that company. His contract is again with the financial intermediary. But if it is a direct finance, you know to whom that you have invested. Either you become a stock owner, that means the owner of that company. If you invest in stocks, you are an owner. You have ownership right. Or from another perspective, financial intermediaries in the indirect finance, they themselves come to the financial market and buy assets from the borrowers, because they issue directly the assets. They're asking the savers to invest directly. So the financial intermediary also become a part of this savers, household, businesses, government, foreigners, and you can say financial intermediary also there. So he come and directly invest through the financial market with the borrower. He pools all your investments and take that money because he has some better advantage in terms of accessing those assets, because he buy not small quantities, big quantities. He can do a OTC transaction. So then he will ask them to price it advantageously. It's like a wholesale versus retail. So you can see what is indirect finance, what is direct finance. The direct finance is the presence of investor and the borrower exist. So you basically directly deal with the financial asset. Whereas the indirect finance, the financial intermediary exists. The savers and the borrowers become parties to the financial markets, financial intermediaries transaction role. So the direct finance and indirect finance are very, very important aspects of financial structure everywhere in the world. In some countries, the direct finance have a bigger share in the market. In some countries, the indirect finance has a bigger share in the market. But generally, indirect finance remain a big share in all the markets. Okay, direct finance, indirect finance, we will get into these details as we move on in our discussions. Any questions?
Sir, financial markets could be the stock market also, no?
Financial market could be?
The stock market.
Stock market is one sub-element of a financial market.
Right.
Bond market is another element of a financial market. Foreign exchange market is another element of a financial market. Then you see commodity markets, the oil, wheat, all trades, commodity markets. But commodity market is not commodities exchanges, they do the transaction, but commodities exchanges related financial transactions happens in the financial market. So tea auctions, coconut auctions, all happens in Colombo. But those are not financial markets, but they are related transactions happen through financial markets. So stock market is only one element, bond market is another element of financial markets, but those two markets are the biggest in terms of the relative share in financial markets. Any questions? Right. So it appears you have some clarity now in terms of the financial markets and its functions. We are taking those stuff little by little forward. I prefer to stop at this point and start at our next discussions. I will first finish these areas in the handout before moving to a fresh handout most likely next week. So any further questions? If not, we will stop at this point and we will continue our discussions and try to read through the supplement and also the handouts, and if you can explain, you can detail out the discussions where you see it's you require some clarity. That also good. I mean, while we are discussing this topics itself, because then you remember the discussion and you can write down short notes and things like that. But as I was always mentioning, read the news, financial news and related things, so that would help you understand this subject area very well. So if you don't have any further question, if anybody wants to raise the hand and ask anything or write it down. So I will stop at this point. Thank you and stay safe.